Good morning, Pete.
Good morning.
This is Financial and Estate Literacy. This is It's Your Money, the spring of 2023. This is week 6, and with the sunset picture behind you, you can know that we are heading into the last session and going through that. So what I'm going to do is I'm going to monitor the chat, the Q&A as we go through this, and I will disappear and let Pete and Laura talk. Bye.
Bye. Hi, Laura.
Hi, Pete.
Good to see you. Love having you on the program. Let's bring up your Ask First form. We're not going to spend a whole heck of a lot of time on it, but I just want to kind of go through that it's so important to understand the CFP. There's no licensing involved, and you have to understand compensation. By the way, Laura has been one of the a national spokesperson for the fee-only community. She has been on national boards of directors. She has taught the CFP courses. She is an advocate for charities. I just feel absolutely privileged to be with you, Laura, on the session today, because you are just absolutely awesome. So I know, but how long have you been in the business? And talk a little bit about you charge, and then generalize it to just what should somebody pay for financial planning services?
Right. So I've been in the business a little over 40 years. And when I started out, I was on what we now refer to as the dark side, kind of the commission side, until I realized there was another way to do that. And we were one of the early adopters of the fee-only approach. And that's where you don't have any licenses, you're not selling anything, you're not getting any trails, you're not getting any referral fees, kickbacks, or anything. You're just being paid by the client. And the most common way that works in the industry is that advisors will charge a percentage of liquid assets that they're actually managing and investing for you. Others do charge hourly fees or per project fees, but by far the most common way is the kind of assets under management approach. And, our firm, we used to do more hourly and project type work, but we found that it was more beneficial for clients to have a long-term relationship working with an advisor, because it's not really, financial planning is not really a one-time thing. And of course, managing the investments is an ongoing thing, but a good advisor is going to work with you over a long period of time and build in the financial planning into the whole relationship. And it's typical that firms will charge around 1%. I think anything more than that is on the higher side for sure. Our fees start at 0.75% and go lower from there depending on asset size.
Yeah, and your minimum in investment today is what, Laura?
5 million.
5 million. And approximately how many clients do you have?
We have about 110 client families, and we manage almost $1 billion in assets.
All right. Let's get, by the way, if you ever want to have a referral to a financial advisor in the community, or please contact Laura. Laura probably knows the vast majority of professionals, and not all have a minimum. So it's a choice that a financial advisor makes as to what kind of practice they'd like to have.
Yep. And Pete's a good source, and I'm happy to talk to anybody too. I always make that available. Yeah, you can reach out to me. Email is the best way, and anything you could tell me about your situation would help me figure out who might be the best fit, and I'll give you usually a couple names. And our list is not that long. There aren't as many of us as there should be who work on a truly fee-only fiduciary basis.
Yeah, and you have to fit. Has to be a fit. So, and just because the individuals accepts a lower minimum investable asset base does not mean that they're inferior financial advisors.
No.
It's just a choice that they make as to how they want their practice. Let's get into the program, Laura.
Yep. So just, I kind of frame this presentation as a case study. I know you've had all the other sessions. Hopefully most of you have been able to attend all those sessions, but hopefully this helps tie everything together, wrap it up, and we'll be able to answer any lingering questions. But assuming this is Bill and Sue Brooks, both 72 years old, retired, total net worth of 4 million, of which 2.5 million is liquid. The rest is their home and some other personal assets. They have 2 children and 3 grandchildren. Not atypical couple in this area. So step one, finding an advisor. And there are many people who've gone it alone or like to go it alone or think they should go it alone. And obviously I think that most people are going to be far better off with an advisor. You can be your own worst enemy as far as kind of second guessing the timing of the investment side. There's so much to keep up with on the financial planning and tax side. It takes a lot of study and ongoing continuing education to be a good advisor. And I really have yet to find anybody who doesn't benefit from an advisor far more than a good advisor will charge. We have clients who are retired CEOs of banks, venture capital, private equity people, lots of people in the business who realize that they're not keeping up with everything and they benefit from having an advisor.
Yeah, same here, Laura. I fully agree with you. I have a financial advisor myself, and I do these workshops twice a year. You just can't keep up with everything if you're not involved with it 8 to 12 hours a day.
Yep. Exactly. 8 to 12 hours a day is about right. Yes.
Yeah.
And you've heard so much throughout this workshop series, fee only fiduciary. And even the word fiduciary can be very misleading because I see brokers and hybrids calling themselves fiduciary. So, that ask first form is a really great screening tool. And I think, when I've seen people as prospective clients, sometimes after these workshops, very few are using the ask first form. And if they've met us here, they've been through it, but it really does help. And it is very easy for these firms to look like they're fee only when they're not. They all want to look that way because they know that's the better way to do business, but they make more money the other way. So that's why everybody doesn't do it that way.
About the money.
And the CFP, I'll comment on the CFP. Actually, one of the reasons I kind of retired from teaching in the CFP program was, not all CFPs are fee only. Most aren't, as a matter of fact. There are CFPs in banks, brokerage firms, insurance companies, et cetera. So CFP doesn't mean that you have the right form of practice. It just does mean that you have the education on the financial planning side. So we think the CFP is important, but it doesn't mean that you have the right form of practice. The FINRA check is super important. Finding out what kind of dirt is on your record. And these brokerage firms and hybrid, they rarely have a clean record. I don't know how they get clients with so many things on their records,
because nobody looks up broker check, Laura.
Yeah. Yep.
And it's remember, Google broker check. It'll get you directly to the FINRA website.
Right. And if you are an advisor not affiliated with a broker dealer, which is what you want, it'll take you to the SEC site, which is the regulatory side for the non-broker advisors. So it gets you there either way if you do the broker check.
Who is your custodian, Laura?
So we use both Charles Schwab and TD Ameritrade.
Okay.
So just to clarify that, though you don't want to work for a brokerage firm, you will want your assets custodied at a broker custodian. So we can use any of the custodians, Fidelity, we could use Bank of America. We work with Charles Schwab and TD Ameritrade. But we don't work for them, and we can move our clients anywhere at any time. So those are usually brokerage firms that tend to be independent. And just, I will make a comment about that. Both Schwab, TD Ameritrade, and Fidelity have their own brokers in-house that sell Schwab products and Fidelity products. And they compete with advisors like me, essentially. And they've been known to say, we don't participate in that because we don't do fee sharing with anybody. So advisors who are on those approved lists for Schwab and Fidelity, they pay to be on that list. They are not on that list because they're better advisors. We've had advisors use that against us because we're not on the list, like Tarbox wasn't good enough to be on the list. Well, we don't participate in those because we don't want to be owned by them. And so when you get those clients from those advisors, from Schwab or Fidelity, you can't move them somewhere else if you think there's a better place to be. Schwab owns them, Fidelity owns them, and you share fees with them. So we personally don't like to do that. There are good advisors who participate in that program, but just be aware of what it is. And the brokers and the branches who refer it, they get paid for those referrals. So they pay the best salespeople who can close the deal.
ADV, that's what if you have an independent advisor, please review their ADV. It has an entire story of how they charge and whether or not they give or take referral fees. And they have to disclose that relationship that they have with Schwab, Fidelity, TD Ameritrade, Merrill Lynch, Morgan Stanley, whomever. So you want
private equity firms that really own them. So you
Yeah.
know who's really behind them.
Yeah.
That's a big trend in our industry.
Incidentally, since you've mentioned a couple of Schwab and Ameritrade, are they merging?
They are merging.
Yeah.
They are merging, which is they are merging on for retail, different time frames starting about now through Labor Day is when that's going to happen. Yeah.
It's going to be a mess.
It's going to be a mess. Yeah. Best case, it's going to be a mess.
And the free potential advisors, it's really important because it educates you as to language, and also because it's like a marriage. You don't want to change once you've picked one. So really recommend.
Yeah, and everybody has a little bit different style, a different investment approach. If you don't understand anything that your potential advisor is telling you, that's a bad sign if they can't make things understandable to you. It's on the brokerage side, they really try to confuse you. So you think you need them to be smarter than you or whatever. That's not really what it's about.
Yeah.
You need to feel comfortable with the advisor and make sure that they talk to you in a way that you can understand, and that they meet these requirements that we're talking about.
Many of the individuals are not going to find an advisor until maybe later on. If a person wants to do it themselves, any advice that stick with a discount broker, stick with Vanguard? What would you kind of recommend?
The options aren't as good as they used to be. Vanguard was a good option, but they've kind of moved in the direction of everybody else, and nobody in any business in our country right now, I feel like, has enough good employees working for them. Everybody's short-staffed.
Yes.
And that's certainly true in the financial industry.
Vanguard just is training 10,000 new employees. So
yeah, and it can be a couple hours of wait time, even if you have substantial assets.
Yes.
Their investments are good. Their advisory platform, I'm not so sure. Again, Schwab is going to try to sell you their funds and their programs. That's one reason we like TD Ameritrade. They didn't have their own stuff, but that's going away. Fidelity's, relentless about trying to sell you annuities. And I think you've heard how we feel about that. Those are still probably the better options if you're doing it yourself. I mean,
let's go to the next slide.
The broker. So this couple, they need help investing their retirement funds. They were doing it themselves. They feel like they're at a point where they would like to get some help and support there. And they want to make sure that their money will last. How much do they have to spend on travel, et cetera? They want to get their estate in order. There's some pending changes in the state tax laws. They want to know if that applies to them. And they have a goal of gifting to favorite charities, want to talk about gifting now versus later. So the first step most advisors would go through is, gathering all the information, which is, it takes some time for you to put your stuff together. And, a good advisor is not just going to look at your investment statement, your brokerage statement. They're going to want to see your tax return. They're going to want to learn about what kind of insurance you have in place. They're going to want to know a lot about you.
They want to know about your kids.
Yes. Yeah. What's your family situation?
Yeah.
What's your plan? What things are on your mind? What is worrying you? I think, kids is at the top of the list for people who have them. People who don't seem to be.
Yeah. And if you don't have kids, you don't have to worry about them.
So all that is very important. So we put together a balance sheet so we can make sure we're capturing all the assets, and then we update that on an ongoing basis. But a balance sheet, can be in many formats. It's simply what you own minus anything you owe, and that is your net worth. And we list, bank accounts, any real estate, brokerage accounts, retirement accounts, etc. And then we're going to look at spending and cash flow. That is a very important part of what an advisor should do. Most advisors have software to do that. The brokerage firms have software to do that. All of that is only as good as the input that goes in, and you can do a lot of that yourself online. But making the right assumptions is super important, and that's something you should give some thought to, what assumptions you're using or your advisor's using to put into that program. And we'll talk about that a little more in a bit. But this couple has Social Security of $3,600 all in, and pension income of $1,800 a month, and expenses of $150,000 a year. So doing that math, that means they need about $85,000 a year to come out of their investments. And one of the questions, of course, we want to know that's really important: does that pension have a COLA on it? Is it flat at $1,800, or is there an inflation increase on that? Most of them don't have that. Most people don't have one anymore, but those who do typically don't have an inflation rider. And does that continue on after the death of the working spouse, and continue on for the remaining spouse or not? Obviously, a big part of the equation, and that needs to be factored into this cash flow planning. Reviewing the tax return is super important. We can learn so much about you from your tax return. Lots of important information there, and that's going to affect how we build an investment portfolio, what kind of planning opportunities might be available, etc. So during
before you go to step 4, couple of things that I always encourage the person to talk about is 2 other points, and that is, 1, how do you have title to all your assets when you're gathering the information, and also what is the cost basis of your assets?
Yep.
I've seen too many times where somebody goes to a new advisor and they sell the entire portfolio and incur just a huge tax situation because they want you in their particular program.
Yeah, I can't believe that still happens, but it does, and we've seen it as well. So that's something to ask up front. If I have existing investments, are you going to sell it all when you take it over? And if they say yes, that's not the advisor for you.
Yes,
unless it's all in IRAs.
Yes, exactly. Not a problem, but how you have title is really important.
And ideally, on the balance sheet, we track the cost basis of assets and how they're titled, so we can make sure everything is properly titled.
Yeah.
And that if you have a living trust, we'll talk about this in a bit. You have to have your assets titled to the living trust, or it's not really very useful. And invariably, we find assets that haven't been titled to the living trust. So a lot of those cleanup items happen.
Yeah. Let's go to the next slide.
So insurance review is important depending on what phase of life you're in. There's different types of insurance. Whatever medical insurance you have while you're working, you probably have, somewhat limited choices there. If you are of Medicare age, there are actually lots of choices to be made there. And there are lots of consultants or insurance agents who can help you with that. We have a couple sources where they review every year what your options are, because they change and the products change. So you should have somebody good working with you on that. Obviously, that's still a big cost in retirement is your medical. Long-term care insurance, do you have it? Does it make sense? A lot of people bought long-term care a while back and things have changed, and you're being presented options on how to continue your coverage. If you want to continue it, do you have to pay more money? So an advisor should be able to be an objective reviewer of your options there and what makes sense given your situation. Homeowners, auto, personal liability insurance is important. A lot of advisors don't have the direct expertise in that, but they should have contacts of people who can do an in-depth review or just make sure that you have some of the basic coverages. Most people should have an umbrella liability policy of $1 million to $5 million. It should only cost you a couple $100 a year. A $5 million, I think we just had someone get one for $1,200, $1,300 a year, and that's going to pick up where your auto and homeowners insurance caps out, or if you have some liability claim. And it's a very small likelihood that could happen, but it obviously could wipe you out if somebody has a claim because something happened on your property. If you have any rentals, of course you have insurance on those, but you want that umbrella level of coverage on top of it for sure. Most people have some old life insurance policies. Life insurance needs to be managed as well. Unfortunately, the way that the insurance industry works, for the most part, somebody gets sold a life insurance policy and then you probably never hear from the agent again unless they're trying to sell you another life insurance policy or more life insurance. And if it's any type of cash value insurance, especially, it needs to be reviewed every so often. Many of those older policies are set to run out or implode before you do. So that needs to be managed and analyzed, and a good advisor should be able to do that as well.
What if the advisor sells insurance as well?
Then it's not a fee-only fiduciary advisor, and there's so much money to be made in insurance that it's really hard to be an objective advisor when you sell insurance. I mean, it just seems like life insurance is the answer to any problem.
Yeah. Yeah. Be
So,
careful.
Yeah, most people we see have way more life insurance than they need, or they needed it at one time and they don't necessarily need it anymore. It can be a great tool for sure. It does have tax benefits, but you really need to have somebody objective, ideally who's not selling it, to look at your situation there.
And this is the area, tax planning, where I see almost one of the best values that a professional can give to their client.
Yep. And it should, a CFP is trained in this and should be thinking about it, should be reviewing the client's tax return every year and working with them throughout the year to do the planning. Very few tax preparers or CPAs do tax planning. Most of them don't have time to do it. They're not set up their business isn't set up to charge for that. They charge you a fee to put the numbers in the boxes on the return.
They account, they don't plan.
Right. And it's a different, it's usually a different kind of mindset of a person, a CFP versus a CPA. And we're looking at the whole picture and how taxes intersect, and not just, just the taxes themselves. And there's a lot of opportunities here. I mentioned before, we do review all the tax returns when we get a new client or clients that we work with. And I think 80 to 85% of the time, there are outright mistakes or what we consider glaring missed planning opportunities. And it's just, we ask our clients, if they have any complexity of their situation, and if we're not all that familiar with it yet, to review the tax return before they file it, because there's a lot of things. There's a lot to keep up with, and especially if you're not with a big firm and paying a lot of money to have your taxes prepared. You know, a smaller firm, they're busy, they sometimes miss things. So there are a couple of things I want to mention specifically that are big things we look at the last few years, and that's kind of batching your itemized deductions every year. And that's because they raised the amount of the standard deduction a few years back. So it's a little over 13,000 for individuals and almost 28,000 for a married couple. So if you don't have itemized deductions of more than that, you get the standard deduction. So what we recommend is bunching your charitable giving specifically, and anything else you can, into 1 year, and do go light the next year, for example, so you could go over that hump of the standard deduction to get more bang for your buck, especially on the charitable side. So that's kind of a common planning technique that we do, and that that's where a donor advice fund can be a good fit. I think maybe you've heard talk of those in this session, or maybe the estate planning series, but that's a great way for a lot of people to do charitable giving. You can open an account for as little as $5,000 at Schwab or Fidelity, and you are able to get a deduction the year that you put money in that donor advice fund or DAF, and yet you can hand out the charitable distributions to your charities anytime in the future. So you can use that DAF to time your tax deductions, but then you could gift every year if you want.
Does a 72-year-old still have to consider a Roth IRA conversion?
Possibly. It's something to look at because rates are going up. There's a lot of moving parts to the Roth conversions, but we find it doesn't make sense very often. I mean, unless you're really in a very low to no tax bracket, and you can plan around the brackets to do that. Otherwise, if you are going to have a tax due on a Roth conversion, you really have to think twice about paying a tax before you need to.
Yeah.
Because all the rules change.
Run the numbers.
Run the numbers. Yep. And that's where we work really closely with our clients' CPAs. We do the work, and that's included in that 1% or lower fee.
Yeah.
So there's not an extra fee for us to do that kind of planning, where if the CPAs do that, they'll charge you a fee for that. So we'll usually do the work, and then we'll ask the CPA, does this make sense? Do you agree with it?
Tax loss harvesting is almost a lost art. What is that?
So tax loss harvesting is a way to make lemons out of lemonade, as we say, in a year when the market is down, to be able to take some tax losses, perhaps, to offset gains in the current year or to carry over for future years. It's like money in the bank. And if your advisor hasn't been taking advantage of that, or didn't take advantage of that last year, that's a huge potential lost
opportunity.
Thank you. And that's, a good advisor managing your investment assets is going to be looking at that all the time. Usually we have software that helps us rebalance the portfolios and take into account opportunities for tax loss harvesting and offsetting gains. And that's why, the ideal situation is when you have a year where you made a lot of money on your portfolio in an up year, but you were able to tax loss maybe in periods of that year when that market was down and you have losses. And I can't even believe it. We actually had a CPA tell us that our 1099s from Schwab were wrong or something, because they made money on the portfolio, but we were showing a tax loss, and the CPA didn't even understand how that could happen, which was a little scary. So
well, tax bracket planning, we talked about the tax brackets in the first session, but what do you mean by tax bracket planning?
Yeah, so there's obviously lots of things that affect what tax bracket you're in and what kind of income you have during the year. Social Security factors into it, the Medicare, IRMA factors into it. And, that's a very complicated concept where they're looking back a couple years at what your income was and raising what you're paying on Medicare. And there's some planning around that you can do to reduce the impact of that. And keeping, you know, if you're keeping all your income below a certain bracket and not taking income, if you have the ability to do that in a year where you might go to a higher bracket.
You know, it's the people invest in municipals without understanding their own income tax bracket, isn't it? You know,
that's another,
sometimes it's contributing to an IRA when they don't understand their income tax bracket. A young person may want to, just starting out, invest in a Roth IRA versus a regular IRA because of their tax bracket. I'm just throwing out examples that it's important to know your tax bracket before you invest money.
Yeah, and just as a general concept, you know, the older you are, even if you're getting a tax write-off, the less benefit you're getting from making an IRA contribution, because you have a shorter time span before you're going to have to start taking that out. And it may not be worth it. Again, that's one of the things we look at, like what's that tipping point where, you know, you're getting such a small write-off because maybe you're not in a really high tax bracket, and then you're just going to have to take it out down the line and pay taxes at ordinary income rates on the full amount. So
I'm just throwing this out right now, but we could talk about it later. But you just mentioned time and investments. And so when we get to the investment portion of the talk about the importance of time.
Yeah. And how that makes a difference.
Yes,
for sure. But lots of opportunities for tax planning. You know, it's something that we're doing all the time, thinking about it behind the scenes, as the rules change. A lot of things have changed. Actually, sorry, with the rules, I didn't mention the QCDs here at the top. Super important, the qualified charitable distributions, which allows you to contribute up to $100,000 from your IRA directly to a charity. Many of our clients are taking advantage of that. As I said, those assets in that IRA are going to be taxed 100% in ordinary income rates. It's a great way to give money to charities while you're here. It's not always the best way. Sometimes you're better off contributing directly and getting the write-off. And that's another place where we run the numbers. Should they do the QCD this year, or should they contribute directly, or is it a blend of that?
Yeah, and just a couple other points, and that is the charitable gift annuity and the charitable remainder trust. This year, first time, you can do that from your IRA account. Again, you need to run the numbers.
Yep. And those are great strategies that everybody should be looking at if you have some charitable intent. And, you know, there's a lot around that I think that's happening out there right now. I think a lot of people are starting to look at whether it makes sense for them to be able to give more of their assets to charity while they're living, both to charity and to their beneficiaries and to their children, perhaps. Which may make a lot of sense as far as reducing your estate now. And, you know, if you run that cash flow planning and you realize you're not really going to spend all your assets at the current rate, you may have some more opportunity for gifting during your lifetime, which I think both on the charitable side and the family side can be very rewarding instead of waiting until you're gone.
And you don't get an income tax deduction when you're dead. So think about it during your lifetime. It's a lot more pleasurable. Let's go to the next slide.
Well, you do get an income tax benefit when you're dead.
Yeah.
By the step, not on your IRA, but on step up in basis is.
Yes, definitely.
But on your IRA, no benefit, you know, you give that away.
But yeah.
So except for charitable gift annuities, which can be a great way to gift to charity, and, you know, especially as rates are a little higher as far as what you will get, that's where you make a gift and you get a lifetime or a term payback income from the charity. But as far as commercial annuities that are sold to you by a broker, insurance person, a bank, they're
credit union, Credit union.
Yeah, they really don't make sense in pretty much every situation. And they make them very complex. There's all kinds of bells and whistles, and they use all the words that sound really good. And, you know, very smart people have invested in these and thought that they made sense, and they're very tough to get out of. They're very expensive, and they're very tax inefficient. You take money that could be earning long-term capital gains in an investment portfolio and turn it into ordinary income. So you can only get it out as ordinary income. If you die with it, your beneficiaries will pay income taxes on that. Gains taxes on that, no income taxes on that, unlike the rest of your portfolio. Many, many reasons not to invest in annuities. And the question is, many people have invested in them because the sales numbers just keep going up.
$10 billion just this last year.
Yeah.
It's just amazing.
Actually, I would have thought it was more.
Yeah, well, I think that's just new sales.
Yeah. You know, whenever the stock market has a bad year, all the annuity sales people say, oh, you can invest in annuities and have the upside, but be protected on the downside. It's not what it looks like.
Yeah, we went all through that in our session on annuities. So I think your statement right there in bold says it all.
Yeah, I used to teach an 8-hour class in annuities to CPAs all over California. So you know, part of the thing is figuring out how to get out of them if you're in them, and it usually is too costly just to cash them in. So there's usually a staged exit,
and it's not easy.
Yeah, but an advisor can help you with that. So other than annuities, just kind of the core investment process. And we always say, you know, the investment part of what we do for clients is, you know, it's kind of the engine that drives everything and super important. Like we always say, you have to get that right, but it's on the other hand, kind of the least of everything that we do, because it's all the other stuff that makes, you know, the investment piece work better, and really looking at everything as a whole, the tax planning side, you know, looking at insurance factoring in, all that, your cash flow, how you draw from a portfolio is an art to figure out where you pull that income from. Super important. I know you've had just kind of an overall in the asset allocation, but just first of all, figuring out what asset classes are you going to use, make the pie, and implement and rebalance periodically. And just a comment about the asset classes to be used. Don't try to get tricky. Don't try to shoot the lights out. Don't try to beat the market. I had somebody who runs an investment group in a big retirement community asking me a bunch of questions about, you know, what's out there, what's going on. And he said, everybody here is asking what we need to do about Bitcoin. And I said, nothing. Don't do anything from Bitcoin. Run away with it. Nobody needs Bitcoin. It's speculative. It's not an investment. I mean, I think a lot of people have realized that lately, but it's not part of your, you know, retirement portfolio. It's, you know, the underlying technology has a lot of potential, but buying any of the cryptocurrencies is really not for most people.
Stick to the basics, you know. To the
basics. Yep.
Yeah, you know, companies make products and earn money, and that's where you invest.
Yeah.
It's no longer, it's the more complex you try to, the more complex the financial services industry makes it, because they're selling you a new product. It's not about what's best for you.
Yeah, and you know, that goes across so many things. I'm started working with a young woman whose father died, and she inherited a lot of real estate and a huge trust deed portfolio. And everybody thought it was, you know, a good investment because many of these trust deeds were paying 8%, 10%, even 12%. And I think there were 14 of them when I started with her a couple years ago that were kind of waiting for them to mature and get out of, but 5 or 6 of those have been foreclosed on. And, you know, we've lost all the money in a couple cases. And so, you know, that 8 to 12% return, when you lose like a third of the assets, that number goes down really quickly. So when you hear those things on the radio actually anything you hear on the radio is not a good way to choose.
Anything you
What
hear
to
on the
invest-
anything you
Yes.
hear on the TV, it's the same thing. It's just it's the last place you want to go because that's what they're selling. And usually they're selling things that are in their own best interest, not in yours. Let's go to the next slide.
Wait, what does rebalance mean?
So rebalancing, okay, so let's talk about it in the context of these different portfolios. These are kind of standard names for general investment models that are used around the industry. Different firms have different variations of these, but these are pretty common, pretty common nomenclature, with the moderate growth being kind of the standard traditional 60% stock, 40% bond portfolio, sometimes referred to as the standard endowment model. We think of that as kind of an all-weather portfolio, a good place for a lot of people to start. You're going to capture the upside of the stock market, get some protection on the downside with the bond market. And, you know, depending on how much you need your portfolio to earn, you may be able to be more conservative, or especially if you're still earning and adding to your portfolio, growth might be better.
You know, repeat that, because most people go and say, I want to earn the highest possible return. But
Yeah,
that's not what you're trying to do.
That's not how you should start out. You should look at what you need and how much risk you need to take. And, you know, we generally try to keep people in as conservative a model as they can afford to be in, except for stable. That's too stable. That's too conservative for pretty much anybody. Either if you have a ton of money and you don't need any return, or you're super risk averse, stable, but the return there is barely going to keep up with inflation.
So I have a moderate growth portfolio. What does rebalancing mean?
So rebalancing is in a year when stocks are down, then you would sell the bond side and buy more stocks. So it's a forced strategy or methodology to investing. So it forces you to buy when the market's down and sell when the market's up. So you sell the thing that's gone up. In a good stock market year, you sell your winners. You sell what's up and you buy what's down, so that you keep your portfolio kind of in that mix. And, you know, firms have different parameters around how much they can run when an asset class is going up. But you don't do it right away, and you don't do it without looking at tax consequences. So rebalancing is pretty easy in an IRA. You can do it more often, keep it closer to the target. On a taxable account or trust account that's taxable, you want to watch very carefully the tax situation. So that's a dilemma that we have as portfolio managers, is if there's a huge built-in gain in a particular asset, and, you know, we really want to pare that back because it's too much of the portfolio, we have to weigh, you know, the tax cost of that. And that's where, you know, you want to capture those losses in a down market, or when those asset classes are down, and kind of book those losses for times when you need to rebalance another part of the portfolio. So this is very generally, and I think I split it down. This is this moderate growth portfolio with the sub asset classes. So in stocks, on the stock side, you know, the small and mid cap stocks may not be doing as well as the large cap stocks. So you could rebalance within the stock portion of the portfolio as well, or rebalance in the bond portion of the portfolio. Last year was a really weird year. I think everybody's heard about how it was, you know, off the charts unusual, in that both stocks and bonds were down a lot. There was no place to go last year. So there wasn't a lot of rebalancing opportunity last year. It was a much tougher market as far as that is concerned. And it's no surprise that it was like that last year, because of the Fed, you know, raising interest rates too much and too fast, and just tanking the bond market, which also kind of helped hurt the stock market. So we're in more normal times now, where you know, bonds are actually getting some good return, and there's not as much downside in bonds, unless the Fed really goes crazy and keeps raising interest rates more.
If somebody wants to put together their own asset allocation chart, something like this, should they go to Morningstar, or is it Morningstar? Would that help them figure out to put their own pie chart together?
Morningstar is a good place to go. And, that's where I think Vanguard, we think the Vanguard models, therefore models, and they use the same terminology. I think they have very good mixes, and you could buy kind of an all-in-one fund at Vanguard, like the Vanguard Life Strategies Moderate Growth Portfolio, that gives you a mix and they rebalance it for you within the portfolio. And it's a pretty good way to go to keep things simple. Or you can build your portfolio yourself with all the pieces of this and rebalance it yourself. Some people have fun doing this. So the problem is you have to have a discipline, and you have to not get distracted by what's going on in the world, because that'll cause you to make the wrong decisions at the wrong times. And that's true for professionals too. It's like, if we didn't have a discipline, it's very easy to get caught up in like, oh, obviously this is going to happen. Obviously, looks like we're headed for, the debt ceiling thing. We should get out before June 1st. Well, that is not obvious. It may not happen, and even if it happens, it's baked into the market somewhat, and you're very likely to make a bad call there.
Well, in the investment world, there's been a whole new movement in behavioral economics.
Yep.
That just talks about how the mind impacts your investment portfolio.
Yep.
And that's where that discipline comes in.
Yep. And as a matter of fact, they've now incorporated some of that behavioral finance training in the CFP certification program, which is cool. And I think it is Vanguard who's done that study over time of the return of an investor doing it themselves versus a return of an investor with a professional advisor, because the person doing it themselves is more likely to succumb to, thinking that's not right. And really, you really aren't going to do so badly if you bought a portfolio like that, especially if it's one like that's being rebounced for you at a Vanguard, and forget about it. Just
don't look at it.
Don't look at it all the time. Don't let whether your portfolio is up or down to determine how you feel that day. I say that for portfolios and scales for weighing yourself. Don't let that determine what your attitude is going to be that day.
One of the things that we do have on our website is a bunch of articles, and they'll have the Dunbar study on there showing that the average investor doesn't do very well, and because they listen to the news and make changes. The other one that we have articles on the scams that are out there. By the way, scams are everywhere, are every day. Are you seeing any new ones, Laura, that you want to talk about?
So it's really scary right now. And it's something that we spend a lot of time here thinking about, worrying about. And in fact, we are required to do that. We have to have a certain plan, and we have to have all this stuff, for our regulatory bodies. But and all the big brokerage firms, the Schwabs and the Fidelity, spend a lot of time on this, and it is getting better and better. It's very scary. And, just the basic rules of never give money to anything that's initiated with a phone call. Don't click on any links in your computer. Just don't click on anything. And it's,
by the way, it's so good that and enticing. They're not amateurs, and if I'm in a rush and it looks so good, I barely can hold back from clicking on it. So it's not easy.
It's not easy. And we have so much training in it, all the time about the newest things. And almost daily, somebody's sending somebody saying this one's bad, right? And we have 2 IT guys that will check it out. Like, no, of course that's a scam. And you look at where it comes from, look at the email address that's sending it, and it's like, oh yeah, there's some weird thing in there. We have I think we have really smart clients and very well educated clients, and you know, it's the things that people have fallen for is kind of crazy. And especially if you, and these are people, even some of them in the workplace, but if you haven't been in the workplace, even in the last couple of years, it's changed so much. And one of our clients was working on the computer, and it just went dark and lights went on and it made noise, and it said, you know, you've been hacked, your computer's being taken over, click here. And, you know, right now, and you could get the Norton Fix It, you know, software. And she clicked and she was terrified. And this is, you know, it's a PhD high up in a university here locally. And she, one thing led to another, and she basically, then you have to call here and we're saying, okay, give us your email, we're sending you the thing. She got on, and basically they took 35,000 out of her Wells Fargo account is where that ended. And you know, super embarrassed and crazy. And they got all her information, and just a nightmare situation. It can happen.
It's getting to a point where I recommend to individuals, do not answer your phone. Let it go to voicemail.
It's not impolite to not answer your phone anymore.
Yeah.
It's okay.
Yeah.
And it's not impolite to not return emails. I mean, there's so many suspicious emails. And
yes.
You know, just a couple other things. I mean, we actually had a client you know, fall for a romance scam. And you know, if anybody's lost a spouse, you know, you're not yourself for a long time after that happens. And again, a super intelligent woman met this guy in person at a ballroom dance thing. And one thing led to another crazy saga, but and she ended up going to Wells Fargo, and Wells Fargo let her move 750,000 in Bitcoin to this guy. And so we ended up, by the time she told us, first of all, she lied to us. So if you're lying to your advisor, you either need to get a new advisor, or you know you're doing something you shouldn't. Unfortunately, we didn't fire her for lying to us, but the FBI, of course, it's in Bitcoin, it's gone. I mean, you know, smart people fall for things, and of course, it's humiliating, embarrassing, and you know, life-changing when it's that kind of money.
Yeah.
But the other thing,
by the way, I think the message is smart people can be, and many times are, scammed. These are professionals. I mean, professionals. They're really good at what they do and how they do it.
Yep.
Do not be embarrassed.
No, and I just do want to mention, I mentioned before we started with Pete and Don, that today's podcast of the New York Times Daily is about these charities that are all robocallers, and they're raising money for, you know, the firemen, the policemen, the vets, the injured vets. And they played some of these calls, and it sounds like a person. They have a folksy voice. They tell jokes. You listen to the whole conversation. This is AI already. It's going to get better, but it sounds like they know you. They're talking to a real person, and it's so scary how good it is. But all those organizations, there's a really great investigative piece that they've done. About 1% of the money that people give even goes to those causes.
Yeah.
And they raise it in $50 to $100 increments. So don't give money to anybody. Don't answer the phone, and don't give money through the phone. Like, tell them to send you something, and then go look it up on GuideStar and be sure it's a real charity.
Yeah. So it's the phone, it's your computer, it's also individuals that you meet at possibly your church or at
Free dinner.
Or free dinner. It's your money, and everybody wants it. So you need to make sure that you protect yourself.
And one last thing on that I do want to mention is, when we've had people have issues, there's a lot of things you can do, including a credit freeze and all that, which may be the way that some should go. And financial advisors are pretty well versed in this, but at a minimum, we recommend that people have a credit monitoring system. Like, we use LifeLock. I think it's under, you get under 100, maybe a couple hundred a year. And then you know if somebody's tapped into your account or taken out a credit in your name or is pinging your information. So it's just it doesn't stop things from happening, but it's a good way to know if anybody's messing with your information. And also, one final thing, ideally it's much safer to get your statements online than it is in your mailbox. Even if you have if you have a very secured locked mailbox, maybe, but we've seen more problems with that too. So,
By the way, and the reason for all of this is that Orange County is one of the wealthiest communities in the country. And so this is where a lot of the scams take place.
Yep.
And, you know, many parts of the country don't have $500,000 to $1 million homes and above. So a lot of the scams are located here. So be careful.
yeah,
Sustainable.
and
Go
just,
ahead.
sorry, that made me think too. Of course, there are companies capitalizing on that. And I know one of them is like protecting the title on your house so somebody doesn't steal your house from under you. And those are, most of those companies are scammy as well. I mean, talk to your CPA, talk to your financial advisor before you sign up for any of those things. That a lot of that isn't really what you need.
And that's all included in your fee. You know, it's not extra. This is what your financial advisor should be helping you with. It's not about just trading stocks or making the right CD choice. This is what it's all about. It's having a partner in your own finances.
Yeah, and we, you know, again, that business model of charging by assets under management, we want our clients to call us as much as possible before they do something. And if not, okay, afterward, we'll help either way. But it's like we encourage like more contact is better for us. That's what we want to do. We're here to help on that. We don't want to see anybody go through any of that.
Spending analysis is,
So we
are
call
you going to talk about budgets?
Yeah, not exactly a budget. So, we have a budgeting form that people can use if you don't really have an idea of what you spend. We can, and then, you know, we can check that against your tax return and see if it makes sense, because a lot of times it doesn't line up, and there's kind of like, oh yeah, that I forgot about that. But you know, it's good to know what you are spending. And how much you can afford to spend. And this is, you know, this is also called it could be retirement analysis, capital needs analysis. And you can solve for different things. You can solve for, okay, given my assets, what's the maximum I could spend? Or if I want to spend $100,000 a year in retirement, what does my nest egg need to be? How much of a nest egg do I need? Or I'm spending $6,000 a month. When does my money run out? So there's lots of different ways to go at this. But we call this a sustainable spending analysis, see like how much you'll have, how much do you need, calculating any additional savings that you're doing, any inheritance. It's very tricky to figure in the inheritance, and especially even when it's very certain. I mean, it's never 100% certain, but in some cases it is. It's in an irrevocable trust. They can't change it. It could be very certain, and people tend to not want to count it because it's kind of a gift. But it's also, it could be problematic not to count it. If you know that's coming and you kind of have some sort of a timeline, you know, you don't want to underspend or not buy what you need if some money is coming down the line, or, you know, tax wise, it's going to change the situation. If it is unknown, you know, a lot of times we won't include it, but that's something that should be discussed. If you're doing one of these analyses, your advisor should be talking about what assumptions should we use? What makes sense to you? What's going on in your life? Yeah, we have a client now who's the sole heir to his father's estate, and dad turns 100 next month. You know, pretty certain that's going to come in the next 5 years. And it makes a big difference to what we're doing with the portfolio and all the assets in his.
But every business does this, you know, puts together what they're going to spend in the business. Well, we just don't do it in our personal life. And how can we possibly invest in our asset allocation and in our portfolio if we don't know the answers to these questions?
Yep. And inflation and taxes, super important. You know, inflation assumptions shouldn't change too much over time, depending on what's going on. You know, yes, it's higher right now, but, you know, you can look at historical numbers, and, you know, you could be more conservative on the inflation number and more aggressive on the investment return number. It's like how all of these go together is very important. And sometimes we'll run numbers at one inflation number versus another inflation number, just to show the enormous difference that a 1% assumption makes over 20 years.
Well, we talked about that. We were talking a little bit about time in the investing world. How important is time?
It's very important. The more time you have, theoretically, the more risk you can take. But it depends on what that means. And I think people kind of look at that the wrong way sometimes. Like, I think I only have 20 years to, or, I only have 10 years to live, so I can't take too much risk. I think that the risk is more, if you can handle the risk, and if you're not going to spend all your money and it's going to your beneficiaries or your charities, you might want to still take a little risk there on the investments, as long as you're going to have enough to meet what you need during your lifetime. And you can't, very few people can afford to put everything in fixed income and bonds. You need to have some risk, at least a little bit, usually on the stock side, to get a return.
Yeah, you want that compounding to work for you.
And yeah, the more, and for people who are in their savings and earnings years, obviously the sooner you can do that, the more you can do earlier, the less you have to do in the long run.
The greatest gift you can give your grandkids is to talk to them about compounding.
Yep. Yeah. And let them experience how that works. Though, yeah, my daughter finally had some money to save and was anxious to, get into the stock market, knew enough that she shouldn't get into Bitcoin. And, we started last year, and so she was a little disillusioned on that timing. I said, this isn't money you need in a year. And that's why we invested it, and doing a little better this year.
Let's go to the next slide.
Just a couple of taxes, obviously a super important part of this, what you factor in as far as taxes and how that changes. How much you can spend is really important. And then how you spend it, I don't know that I have a slide on that, but it's very important how you get the money out of your portfolio. You don't need to live on just dividends and interest. If you're spending some of that capital gain every year, it's going to be more tax efficient. Just making sure that you've done this analysis and you're not going to run out of money. And then any one-time purchases, a car, gifting, large expenditures. So estate planning, I think all of you have been doing the estate planning classes, or maybe are thinking of doing that in the future. We'll get into a lot of detail on this, but super important. Most estate planning that you're going to put in place can be adjusted and changed. We see people who haven't looked at their estate plans in 10 years or more. Laws have changed, conventions on what you write into trusts have changed, and you'd really need to have this reviewed every once in a while. Any advisor you work with should be looking at your trust and, hopefully reviewing it with you, making sure it makes sense. They're usually not written in a way that makes a lot of sense to people. So I think a good advisor could help act as a translator to, like, this is what you have in place. Does this make sense? We review this all the time, usually annually to some extent, and make sure people want to have the same beneficiaries in there. I've had twice now where we've had people where they had an ex-wife in there and didn't want that. We saw that come into play, which is kind of crazy. So, a lot of people have a lot of different accounts and IRAs all over the place. And that's the other thing about just kind of consolidating and simplifying. There's also the lost accounts that are out there. It's crazy. We've found many of those for people where they forgot they worked there and they had a pension account somewhere. So consolidate, simplify. So you know where everything is when you need to change your beneficiaries, et cetera.
I get one of the questions I get a lot is, should I see my estate planning attorney first, or should I see or pick out a fee-only fiduciary financial advisor first? And usually my recommendation is pick out the fiduciary advisor first, because they'll know more about your money situation than your attorney. Attorneys are horrible when it comes to advising about money. That's not their field. They draft. Estate planning attorneys are like architects. Architects design houses. Estate planning attorneys design trust and estate plans. So
Yep, and it's a transactional relationship.
yes,
It's not an ongoing relationship. And, the better estate planning attorneys are going to keep your information, update you as the law changes, but some of them don't.
no.
And that's not.
It's just a simple thing like, who are you going to choose as your trustee in the event of some sort of incapacity? I mean, that's a huge decision that you should be talking with your financial advisor about, because you have talked to them about your children, about your situation. They know better and can help you. And we even go so far as to recommend that your fiduciary advisor play what's called a trust protector role in an estate plan, where they get to help you choose whoever is going to be your successor trustee. And some of the distribution schemes that some attorneys come up with are just crazy. And again, have your financial advisor involved in that particular aspect of your estate plan. And again, keeping it up to date. People die, people get divorced, people go on drugs, people move out of the country. It's a dynamic document, and it's not just about death. It's about during your lifetime. Who is there, who has the legal authority to help you when the time is needed?
Yep. Yeah, can't emphasize that enough. And lots of changes have happened in the last few years. If you haven't had your trust updated, you might want to look at that. Though attorneys are all overwhelmed, super busy, and probably understaffed like everybody else. And sometimes you have to wait a long time for an appointment. But we like to be invited into the meetings and the planning meetings with the attorneys. I think that's been really beneficial for a lot of our clients. And just a couple things I want to mention that kind of go in this area is that I've seen come up a lot is when you have children who go off to college or become young adults and they're not married or paired up. You have no right to any of their information. I think anyone who's had a kid going off to college and you're paying the bill, but you can't get the grades has experienced that. But also if something happens, and we've had a couple situations just tragic where something happened to the child at college and the parents could not get in the hospital to see the kid. So you need to have that authorization that your child.
An advanced healthcare directive.
Yeah, before they go off and away, super important. And the other thing that we do for sure with our single clients is that if we notice anything that gives us cause for concern, as far as we think maybe dementia is starting to set in, who do you want us to notify and who are we allowed to contact? I think that's also important, especially if you're single, to have all that in place.
Yeah, my sister is just developed Parkinson's disease, and paranoia comes into play, memory comes into play, and I'm begging her to see a fee-only fiduciary advisor to help her out. And now, but she's at the stage where she's not competent to do that. So this is enough. Sometimes we procrastinate so long until a crisis occurs. And sometimes that's the worst time to begin the planning.
Yep. Yeah, I see. We have a situation of somebody who's been a client for 20 years. His wife died 8 years ago, and he's remarried a younger wife, and he's got an $8 million house, but not a lot of other assets. And we got the email from him saying, I've taken on the 4 stepsons and I'm building a unit at my house for them. And I'm like, wait a minute, I think we're going to Santa Barbara to see what's happening.
Yeah.
Somebody else kind of looking out for you there, which if, it's his money, but we got to be sure that nobody's taking advantage. In 2023, the top rate on your estate is 40%, but only for assets over 12.9 million, or double that if you're married. So most people are not affected by the estate tax right now. but that is set to sunset in the end of 2025 and is expected to go back to around $6 million.
What's your prediction, Laura?
We're planning on it going back to 6 million.
Yeah.
But I don't know. It might go away. The state tax might go away.
Nobody really knows.
Nobody knows. And
Nobody knows.
And that's another thing. We walk a fine line with a lot of the estate planning attorneys who are we have clients at this asset level, and they're recommending that they kind of give everything away now with this law coming up. And it's too often that it changes, and making these irrevocable decisions just scares me to death. And especially when these clients are in their 60s. I mean, they're going to be around a long time. So we will push back with the attorney. This is a couple cases where the attorney actually referred us the client, but we work for the client and we're going to advocate for them. And we're like, attorneys make money selling trusts and documents, and they're trying to save estate taxes. I mean, they're not trying to do a bad thing, but they're only looking at that. They're not really looking at the dynamics of your family and all the different ways that things can play out. So, we're telling people to go slowly.
Nobody predicted that we would have a year where somebody had to pay, no matter how large their estate, had to pay no estate and gift taxes. Yeah. So, if anybody tells you that they can predict what's going to happen in 2025, it's who predicted that possibly we can not reach some sort of a compromise between Democrats and Republicans on the debt issue.
I think that was very predictable.
Yeah, but I don't know what's going to happen. Do you?
No. And it could be bad, but that doesn't mean you sell your portfolio, because there's a million examples of that, and it's not going to play out the way you think.
Yeah.
The
17,000 people are so confused over that.
Yeah, that's the annual gift exemption. You can give anybody, and as many anybodies as you want, 17,000 a year, and there's no gift taxes. There's no filing required there.
No filing required. Okay, so it just means that if you give over 17, you're supposed to file. Most people don't.
And it can bite you. I have a case right now where the client did not file gift tax return for properties and money given away 20 years ago, and they've kind of caught up with it, and we're arguing about penalties for not reporting that now. I think that's rare. Usually they don't pick it up. But,
no, especially, but properties are recorded, so that's
yep. But one thing that people do very commonly is they just decide, oh, I'm going to put my son on title of my house.
Please don't.
That's a gift. You've just given half of your house away, and that is recorded, and you would need to pay, you would need to report it. If it's under the 13 million, you're not going to have a tax, but you have to file a gift tax return even though you don't pay. You can't just put somebody on an account. It's a gift.
Hey, we have approximately 10 minutes left.
Okay.
I just wanted to give you a heads up, and we can move on.
Okay. So annual gifts to charities, it's best not to give cash if you have appreciated assets, as you have, stocks in your portfolio that have gone up in value.
Mutual fund share.
Mutual fund shares, a real estate property, a better way to gift. And that's one of the things that donor advised funds work really well for. Again, we're big believers in those. A great way to give. It's like your own mini private foundation. You can
yes, I was going to say that. It's almost like having your private foundation. It's wonderful.
Yep. Giving bequests at death, keep it simple. I think a lot of people put a lot of restrictions in there, but I think keeping it simple.
If you make gifts to charities, get your kids involved or grandchildren involved. It's not easy to give away money, but give them the chore of saying, I want you to give X amount to this, to a charity. Pick one out, make them do some work and report back to you. It's a great way to begin that discussion about money in the family, because most families don't talk about money.
Yep. And another reason, a financial advisor, we have a lot of family meetings and we help facilitate some of those discussions. I think that's very common. Most advisors are happy to do that. And, most advisors like doing that because then they develop a relationship with the next generation, and that's good for business. So, it really works for everybody there. Assuming we want to work with the kids. Some of them we don't. So the final recommendations here, and then we'll have a couple of minutes for questions. Work with only true fiduciary advisors, nobody selling anything. Focus on asset allocation.
By the way, the SEC or FINRA has made a new definition for fiduciary. So be careful. Will we consider fiduciary someone who does not earn monies, commissions from other financial products or from other people, just from the client?
Or if you have a real estate license and you're selling your clients real estate, that's not a fiduciary advisor.
No,
that's not uncommon either. Don't pick stocks. Nobody can do that well over time. Don't time the market. It seems really obvious what's going to happen. It never is. Invest tax efficiently. Again, something that an advisor can help you figure out, putting the higher yielding assets in your IRA, for example, versus, your trust. Put the ones that are more tax efficient. Maximize contributions to retirement plans in most cases. Don't buy annuities except charitable gift annuities. Do not borrow to spend. Borrowing to invest, like a mortgage on a house, is good, but a credit card is borrowing to spend, not a good idea. On department store credit cards and carrying a balance, not a good idea. For college saving for children or grandchildren, 529 plans are the way to go. Most tax efficient, most flexibility. The old UTMA accounts are very difficult to work with and get turned over to the kid whether you want to or not at a certain age. Definitely have a will or trust. You can make changes in most cases. Don't go without, and don't worry about the wrong risks.
What do you mean by that?
For most people, you don't have to worry about your bank going under and losing money. Even now, nobody's lost money. They're saving all the banks. However, it's generally advised that you don't put more than the FDIC limit in a bank, and there's a way around that. But that's not really where the risk is. The risk is falling for the wrong kind of advisor, not having your estate planning documents in place, etc. I'm thinking of other examples of the.
Well, I had a guy who called me up and said he was concerned about the immigration law on his investments.
Okay.
Immigrants were going to come and our taxes are going to go up because of the immigration.
Right. And there was around election time, we always have to pull out the charts. It doesn't matter who's in charge, who's the president, who's in charge of Congress. It doesn't matter. There's no pattern as to what happens to the stock market. Actually, the Democratic regimes tend to do better than the Republican regimes in the market, but that should not be a factor. What's happening politically in your portfolio. You need to be in the right investments, and you're there for the long term. If you need the money in 3 to 5 years, then you shouldn't tie it up and maybe not invest in stocks. But if you're not going to cash in your whole portfolio, you should be willing to take a little bit of risk there by having some portion in stocks and just let it ride. And if you have enough in bonds and fixed income, like we always say, that's what we look at. If you have enough in the bond side to pull your income for 5-10 years, you don't ever have to worry about selling stocks in a bad market into a bad market. So you can ride it out long term.
And the more you focus on it, the more you want to make changes.
Yep.
So sometimes the best strategy is don't look.
Yeah,
don't watch.
Individuals and advisors who trade more, their returns are worse. The more you trade, typically, the worse your returns.
Laura, should I call you an active manager or a passive manager of investment funds? Or
the other term that we like to use is an evidence-based investor. So we're passive or evidence-based, meaning we don't think anybody can beat the market long term. If you invest in a large index of the market over the long term, you typically get 10 to 12% without trying to pick which asset or which stock is going to do best. And, very few people beat the market, and nobody's really done it very successfully long-term. So we are passive or evidence-based.
Based. I like that too.
Yeah.
We got 5 minutes left. And by the way, yeah, that I love that slide. Thank you, Laura. We couldn't do this without the charitable organizations. They literally pay financial and estate literacy to be a sponsor, and that allows us to put the workshops together on Zoom, and also the volunteers. Laura is not getting paid to be here. She's not going to get your list of who's attending the Zoom. You're not going to get a call afterwards. Don is our philanthropic advisor, and he's not being paid. Right, Don?
He's already checked out.
Yeah.
Really?
Well,
Incidentally, Laura, do me a favor.
Yep.
Go to the first page of your presentation and share screen again.
All righty. I'm trying. You can talk. Whoa. That one?
Yes, because we're not going to reach out. You can't find out who they are, but if they want to talk to you, there's an email address for you, which is what you had recommended that people use. And that way they can get a hold of you, because it wasn't at the end. I figured I'd have you go back to the beginning.
Oh, that's sweet of you, Don.
There you go.
Thank you.
Yeah.
Now you can stop sharing it. If they
All
haven't
right.
written it down, there you go.
Yeah, what we're trying to do is put the control in the attendees' hands, so that it's up to you. If you want a financial advisor, then you contact them. They don't contact you. And do we have any questions, Don?
No,
We do not.
we've answered them along the way.
That is great. And by the way, Laura, you're going to appear tomorrow in Laguna Beach at the Susie Q. So if anyone wants to meet Laura, please come to Laguna Beach. And at 1 o'clock, you will be doing a presentation similarly that you did this morning. So thank you. Dawn, do you have any last words of
What do you mean I don't get paid? I'm kidding. No, this has been financial and estate literacy. This has been It's Your Money. This is since I have the sunset picture behind me back here, this is the sixth of the 6 weeks. So we don't do this again until the fall. I forget what time of year it is. And Laura, why don't you say your email address again?
I think you can see my name on the screen. It's laura@tarbox.com.
There you go. Since we did just get that question. Anyway, so I thank you all very much. What I'm going to do at this point is I'm going to turn off the recording.